Hey everyone, I'm Tony with Clarkson Santoro, and this is our weekly real estate update for June 9th. In this weekly series, we update you on the latest trends that are occurring in our real estate market here in San Ramon. Using our more than 50 combined years of experience helping clients buy and sell homes, we explain what those trends mean for you as a homeowner or as someone looking for a house you will love to call home. The current inventory is 80 homes, up from 59 last week. The average asking price of those homes was $2,048,000, which is down from last week's average of $2,086,000. 7 homes asking an average of $1,751,000 went pending this week. That is more pending homes than last week's number of 4, with a lower average asking price from last week's $2,048,000. A total of 5 homes sold this week, with an average sales price of $1,845,000. That average price was down from last week's average price of $2,048,000, and the total number of homes was higher than last week's 4. Now that we've seen what the market did this week, we also like to look at 6 broader trends that help us understand the strength of today's market, and more importantly, give us a context on how the market is changing. The first 4 indicators give us a look at the quantitative numbers, which tell us what the market has been doing. The final 2 indicators are more predictive of where the market might be headed. To quickly summarize last week's report, the market has shifted to a more buyer-friendly status, and that trend started about 4 weeks ago on about May 12th. The first indicator that we look at is our housing inventory levels. The number of homes on the market has been climbing steadily since May 4th and now stands at 80. About 60% over the amount of a normal or average market. As inventory builds, it takes the pressure off of buyers who no longer have to feel the need to compete over every single home that they look at. Consequently, it makes it even more important that sellers do all they can to present a more compelling and presentable home. Buyers are able to be more selective. Last week, this indicator received a score of 42, leaning towards a buyer's market. This week, we give this indicator a lower score of 35, confirming that inventory levels are favoring buyers in this market. The inventory turnover rate is one of the best gauges to judge how hot a market is. Over the last year, the market turnover rate has averaged about 2.4 times a month, but it dropped below 1 on May 21st for the first time since 2019. Today's measurement is just 0.4, lower than last week's number of 0.58. Prior to the market's slowdown, the average home was selling in about 10 days or less, but the average is now nearly 75 days for a house to be on the market, an uptick from last week's 45 days. Last week, this indicator received a score of 40, leaning in the buyer's favor. This week, we give this indicator a lower score of 30, another clear sign that we are definitely in a buyer's market. The amount paid over asking price is another great barometer of the market's strength. Since May 23rd, we have seen the amount drop from $310,000 to today's $208,000, using the 30-day rolling average, which is still a healthy amount over the asking price. But if we look at the more recent 7-day rolling average, this dollar amount has fallen from $321 over on May 23rd to just $65,000 today. Clearly, the trend is changing to a narrower band between asking and selling price. Going forward, this is going to affect the price that sellers will ask for their homes. We think sellers should now be pricing their homes at or close to market value of the home, not expecting a bidding war or much over the asking price like we have been seeing the past couple of years. Some properties went to market expecting to receive multiple offers and be over the asking prices, and are now sitting unsold and are exposed at a lower price than they think they should be now. Counterintuitively, we will probably see some price hikes on properties as they reprice themselves to what they perceive the value of the true market is. Last week, this indicator received a score of 85. This week, we will give the indicator a lower score of 70. The amount paid over asking price is still very good, but it is important to keep in mind that these numbers do reflect the market was like over 30 days ago. Sales prices, based on the 30-day rolling average, have been declining since May 24th, when they hit a high of $2,396,000. This week, the closing number was $2,178,000, which is just below the year's average closing price of $2,184,000. Last week, this indicator received a score of 90, and this week we are lowering the score a little to 85, reflecting that we are experiencing a small but steady decline in property values from the year's high. One of the two predictive indicators that we follow is the Invesco QQQ stock fund. It tracks the health and valuation of the high-tech stock market, and we have watched this indicator drop from a high of 401 on January 1st to as low as 290 a few weeks ago. That number is back down to that low of 290 today, although it did climb up to the low 300s earlier this week. There are clear signs that the Silicon Valley economy is under stress, and there is talk of reducing their risk profile, which usually means reducing hiring and reduced expectations. As the Silicon Valley economy cools down, we will see the effect here in the Valley, as most of our buyers come from the Silicon Valley area. Last week, this indicator received a score of 37, and we're keeping the score here the same at 37. Overall, stocks have declined and are near a bear market, and this will affect a buyer's ability to place extra cash down or their confidence in the economy. The last indicator we follow are interest rates, which have been climbing since August of 2021, when rates were only 2.84. This week, rates are back up to 5.23 from last week's 5.09. It appears that the long-term trend will see higher rates, but this may be subject to the economy's health. If the economy slows down, rates may hold steady. The worst outcome is a slowing economy and rising interest rates, a situation we haven't seen since the 1970s. Last week, this indicator received a score of 42, leaning toward a weaker market. This week, we give the indicator a slightly lower score of 40. In summary, the current metrics and indicators show a market that has changed from a strong seller's market to a market that is more friendly to buyers. Bidding wars are no longer the norm, or even common. In fact, they are very rare. Homes are taking longer to sell, buyers are no longer rushing to secure a purchase. Instead, they are kicking more tires and they have more properties to choose from. Last week, the overall score was 56, and we are lowering that score again to this week's 40, a clear indication that we are in a buyer's market. The next few weeks, we expect to see buyers and sellers adjusting to the new market conditions. As we mentioned last week, it is important to keep in mind the average sales price of a home in San Ramon just 2 years ago was $1,306,000. Today, it still stands over $2 million at $2,191,000, a change of $884,000, or an increase in appreciation of nearly 67% in 2.5 years, or about 26% per year. If our values do decline a little during this transition to a normal market, we still have experienced and we will maintain, for the most part, the most dramatic property appreciation without parallel in San Ramon real estate history. I hope this weekly summary and commentary was helpful. Let me know in the comments down below or contact us directly if you have specific questions about what the numbers mean for you. And if you find this information helpful, hit the like button and subscribe and share it with a friend so that you will always be up to date on the latest real estate news here in San Ramon. Have a safe weekend, and we'll see you next week with a new update.